You knew the trade was no longer valid. The market had already shown you that your idea was wrong. The price action changed. The conditions changed. But instead of getting out, you stayed. Then you added. Then you waited. And by the time you finally accepted reality, the loss was far bigger than it ever needed to be. That experience feels like a discipline problem, but the uncomfortable truth is that it reveals something much deeper about why trading is so hard. Trading is one of the few professions where the correct decision often feels wrong in the moment. Think about that for a second. When you cut a loss quickly, it feels painful. When you wait and hope, it feels comforting. Yet one behavior protects you and the other destroys you. How can a business be easy when your instincts constantly point in the wrong direction? The market does not reward confidence. It does not reward effort. It does not care how much analysis you did last night. It only responds to supply, demand, and the actions of millions of participants. That creates a problem for every trader. You want certainty before you act. The market offers probability instead. You want immediate confirmation. The market often delivers temporary discomfort first. You want to be right. The market only pays when you manage risk correctly. Do you see the conflict? The difficulty is not finding a setup. The difficulty is behaving properly after you find one. A trader can spend years learning charts and still struggle because knowledge alone does not solve emotional pressure. The moment money is involved, information becomes secondary. Decision-making becomes primary. This is why the same person can identify a perfect setup and still lose money. They enter too early. They size too large. They move stops. They take profits too soon. The analysis was fine. The execution was not. And execution breaks down because the market constantly tests your emotional weaknesses. If you fear missing out, the market will tempt you into chasing. If you fear being wrong, the market will tempt you into holding losers. If you need excitement, the market will tempt you into overtrading. Notice the pattern. The market exposes what is already inside you. So what should you watch for? Pay attention to moments when your emotions suddenly become urgent. When you feel an overwhelming need to enter right now, pause. When you desperately want a losing trade to recover, pay attention. When you feel compelled to make back money immediately after a loss, step back. Why? Because urgency often appears right before poor decisions. The best traders are not necessarily the smartest people in the room. They are often the people who can remain objective when everyone else becomes emotional. They understand something important. A single trade means very little. 100 trades reveal everything. Once you start thinking in probabilities instead of individual outcomes, your perspective changes. You stop asking, will this trade work? Instead, you begin asking, does this trade fit my process? That question sounds simple, but it changes the entire game, because trading becomes easier when your focus shifts away from prediction and toward execution. And when execution becomes the priority, you start noticing that the market was never really testing your ability to forecast the future. It was testing whether you could consistently do what you already knew was correct, especially during the moments when every emotion was telling you to do the opposite. There comes a point in every trader's journey when a frustrating realization appears. The problem is not that you don't know what to do. You know where your stop belongs. You know you shouldn't chase a move after it has already run. You know you should wait for your setup instead of forcing trades out of boredom. You know you should follow the plan you created when your mind was clear. Yet somehow, in the middle of a live market, you do something else. Have you ever noticed how easy trading seems after the market closes? The mistakes become obvious. The chart looks clean. The correct decision stands out immediately. Looking back, you wonder how you could have missed it. But you didn't miss it because you lacked knowledge. You missed it because execution and understanding are not the same skill. A trader can study charts for years and still struggle with execution. Why? Because knowledge lives in a calm environment. Execution lives in a competitive one. When the market is moving, information arrives with pressure attached to it. Prices change, opportunities appear and disappear. Time becomes a factor. Suddenly, the simple rules you understood perfectly yesterday must now survive a real-world test. That is where difficulty enters. Think about a pilot for a moment. Reading a manual and flying through turbulence are not the same experience. The challenge is not remembering what the manual says. The challenge is applying it when conditions become uncomfortable. Trading works the same way. The market rarely tests what you know. It tests whether your actions remain aligned with what you know. And this creates a hidden gap, the gap between intention and action. Before the session begins, you intend to wait for confirmation. Then the market starts moving quickly, and you enter early. Before the trade begins, you intend to respect your exit. Then price moves against you, and you decide to give it a little more room. Before the day starts, you intend to take only high-quality opportunities. Then nothing happens for hours, and suddenly a mediocre trade looks attractive. The rule changed because the situation changed. And that is exactly why execution is difficult. Every trading rule sounds easy when it is hypothetical. The challenge begins when the rule demands sacrifice. Waiting requires sacrificing activity. Following a stop requires sacrificing hope. Passing on a questionable setup requires sacrificing the possibility of immediate profit. The market constantly presents these small moments of choice. Each one seems insignificant. But over time, performance is shaped less by what you know and more by how consistently you respond to those moments. This is why experienced traders often become less interested in finding new information. At a certain stage, another indicator does not solve the problem. Another book does not solve the problem. Another strategy does not solve the problem. The issue is no longer understanding. The issue is execution under pressure. Once you recognize this, your focus begins to shift. Instead of asking, "What should I learn next?" you start asking, "Can I consistently apply what I already know?" That question is far more uncomfortable because it removes excuses. If your plan is sound but your actions keep changing, the problem is not located in the chart. It is located in the distance between decision and behavior. So start watching that distance. Watch how often your actions match your intentions. Watch how often a rule survives contact with a live market. Watch how often you modify a decision after entering a trade. Because the traders who eventually separate themselves are often not the ones with the most knowledge. One of the most confusing discoveries in trading is that being right and making money are not the same thing. At first, that sounds impossible. After all, if trading is about predicting market direction, shouldn't the trader with the most correct predictions make the most money? Yet the market repeatedly shows the opposite. You can find traders who are right on 7 out of 10 trades and still struggle to grow their accounts. At the same time, another trader may be right only half the time and produce far better results. How can that happen? Because trading is not a game of accuracy. It is a game of outcomes. The market does not keep score the way a classroom does. There are no rewards for having the highest percentage of correct answers. The only thing that matters is the relationship between gains and losses over a series of trades. That distinction changes everything. Imagine 2 traders taking 10 trades. The first trader wins 7 times. Each winner earns 1 unit. The 3 losing trades cost 3 units each. 7 wins produce 7 units. 3 losses remove 9. Despite being right most of the time, the net result is negative. Now imagine another trader. This trader wins only 5 times. But each winner earns 3 units while each loss costs 1. 5 wins create 15 units. 5 losses remove 5. The win rate is lower, but the outcome is dramatically better. The market rewards the second trader, not because the trader predicted more accurately, but because the mathematics worked in their favor. Do you see why this idea is so difficult for people to accept? Nearly every area of life teaches us that accuracy is the goal. Students are graded on correct answers. Employees are rewarded for avoiding mistakes. Experts gain credibility by being right. Trading operates under a different set of rules. A trader can be wrong frequently and still succeed. That creates a strange challenge. Many traders spend enormous amounts of time trying to increase their win rate by a few percentage points. They search for the perfect indicator, the perfect entry, the perfect filter. But even if they improve accuracy slightly, they may not improve their overall results. Why? Because the mathematics of trading is driven by the size of outcomes, not simply the frequency of outcomes. A single large gain can offset multiple small losses. A single large loss can erase multiple small gains. As a result, the quality of a trading approach cannot be measured by asking, how often does it win? The more important question is, what happens when it wins and what happens when it loses? That question shifts your perspective away from individual trades and toward the larger picture. And that larger picture is where the real business of trading takes place. Any single trade contains very little information. A coin can land heads 5 times in a row. That does not change the underlying probabilities. Trading works similarly. A short sequence of results can create a completely misleading impression. A trader may feel invincible after several wins. Another may abandon a sound approach after several losses. But neither reaction changes the mathematics beneath the surface. The numbers only reveal themselves across a meaningful sample of trades. That is why professionals often think in groups of trades rather than isolated outcomes. They understand that one result proves almost nothing. What matters is whether the mathematical relationship remains favorable over time. Once you begin viewing trading through that lens, the obsession with being right starts to lose its grip. You become less concerned with predicting every move and more concerned with participating in situations where the numbers work in your favor, because the market never promised that every trade would succeed. It only offers opportunities where the potential reward outweighs the potential cost. And when you truly understand that distinction, you start looking at every trade differently. One of the hardest lessons in trading is discovering that the market does not owe consistency to your expectations. Just when you think you understand it, it changes. A setup that worked beautifully for months suddenly stops producing the same results. A market that rewarded patience begins rewarding speed. Conditions that felt familiar become unfamiliar without warning. And that creates a problem. Because while the market is constantly adjusting, your beliefs tend to stay where they are. Have you ever noticed how easy it is to become attached to an idea? You study a pattern. You watch it work repeatedly. Confidence grows. Eventually, you stop seeing it as a possibility and start seeing it as a certainty. That is where trouble begins. The market is not a machine that repeats the same sequence forever. It is a living auction driven by participants whose behavior changes over time. New information enters. Large institutions adjust positions. Economic conditions shift. Liquidity appears and disappears. As those forces change, market behavior changes with them. The pattern may look similar on the chart, but the environment underneath it may be completely different. That distinction matters. Many traders assume their job is to find something that works and repeat it indefinitely. The reality is more demanding. The market rewards adaptation, not attachment. Why? Because every edge exists within a specific environment. A strategy that thrives during strong directional movement may struggle when price begins moving sideways. An approach designed for calm conditions may suffer when volatility expands. Nothing is wrong with the strategy itself. The environment simply changed. Yet traders often respond in the opposite way. When results decline, they double down on their previous assumptions. They become more committed to an idea precisely when flexibility is required. The cause is simple. The longer a belief has worked, the harder it becomes to question it. Success creates confidence. Confidence creates certainty. Certainty reduces observation, and reduced observation makes it harder to recognize change. The market rarely announces that a transition has occurred. There is no bell ringing at the opening of a new environment. Instead, the clues appear gradually. Price begins responding differently. Moves lose momentum sooner than expected. Breakouts stop extending. Reversals occur in places where they previously failed. The evidence accumulates little by little. The challenge is whether you are still paying attention. Because trading is not simply the process of expressing an opinion. It is the process of continually testing whether your opinion still matches reality. That requires a different mindset. Instead of asking, what do I believe the market should do? The better question becomes, what is the market actually doing? The difference may seem small, but it changes everything. The first question focuses on your expectations. The second focuses on observation, and observation is far more valuable. The market does not care how long you have held a view. It does not reward loyalty to an idea. It only reflects the actions taking place right now. That is why experienced traders spend less time defending opinions and more time evaluating evidence. They understand that survival depends on staying aligned with current conditions rather than past conditions. The moment a trader becomes more committed to a belief than to observation, information starts getting filtered. Evidence that supports the belief is accepted. Evidence that challenges it is ignored. And once that process begins, the trader slowly loses contact with what the market is actually communicating. So pay attention to moments when reality starts disagreeing with your expectations. Pay attention when familiar behavior becomes less reliable. Pay attention when outcomes begin changing, even though your methods remain the same. Because the difficulty of trading is not simply learning how markets behave. One reason trading feels so difficult is that every meaningful decision must be made before the outcome is known. That sounds obvious, but very few people truly appreciate what it means. In most areas of life, decisions can be delayed until enough information becomes available. If you are buying a house, hiring an employee, or choosing a business partner, you can gather more facts before committing. The market does not offer that luxury. The opportunity exists now. The information is incomplete now, and the decision must also be made now. That creates a challenge unlike almost any other profession. Have you ever wished you could see just one more candle before entering? Just one more confirmation. Just one more piece of evidence. The problem is that if complete certainty arrives, the opportunity often disappears with it. The market demands action while uncertainty still exists. That is why decision-making sits at the center of trading. Not prediction, not analysis, decision-making. Analysis provides information. Decisions transform information into action. And those decisions must be made in an environment where the future remains hidden. Consider what happens before every trade. You examine the evidence available at that moment. Price behavior, volume, structure, momentum, whatever factors you use. Then a choice appears. Act or do not act. There is no third option. You cannot postpone the market indefinitely while waiting for certainty. Sooner or later, a decision must be made with less information than you would prefer. This is where many traders become trapped. They judge the quality of a decision by the outcome that follows. A winning trade is labeled a good decision. A losing trade is labeled a bad one. But that is not how sound decision-making works. A good decision can produce a poor outcome. A poor decision can produce a favorable outcome. The outcome alone does not reveal the quality of the choice. Why? Because uncertainty was present when the decision was made. Imagine two traders making different choices based on the same information. One trade works, the other does not. Looking backward, it is tempting to believe the winner was obviously correct. But that certainty only exists after the fact. Before the trade, both were operating with incomplete information. The future had not yet revealed itself. This is one of the market's greatest illusions. It constantly makes the past appear more predictable than it actually was. Once a move has happened, every chart looks clear, every turning point appears obvious, every trend seems easy to identify. But clarity arrives after uncertainty has already done its work. The trader who forgets this begins expecting impossible standards. They start demanding certainty from a process that can never provide it. And that expectation creates endless frustration, because uncertainty is not a flaw in trading. It is the foundation of trading. If the future were visible, there would be no opportunity at all. The possibility of profit exists precisely because the future remains unknown. The successful trader eventually learns to stop fighting this reality. Instead of asking, how can I eliminate uncertainty? They begin asking, how can I make sound decisions despite uncertainty? That shift changes everything. It redirects attention toward the quality of the process rather than the comfort of prediction. The focus moves away from needing proof and toward evaluating evidence, away from certainty and toward judgment, away from knowing and toward deciding. And the more experience you gain, the more you realize that trading is not a search for perfect answers. It is a continuous series of choices made with limited information. Some choices will work, Some will not. That part can never be controlled. What can be controlled is whether the decision was justified by the information available at the time. Because in the end, every trade presents the same question in a different form. Given what you know right now, what is the most reasonable decision you can make? One of the biggest misconceptions in trading is the belief that success comes primarily from talent. People admire the trader who spots opportunities quickly. They pay attention to the person who seems naturally gifted at reading charts. They assume that exceptional results must come from exceptional instincts. But if talent were the deciding factor, far more intelligent people would succeed in this business. The market has a way of challenging that assumption. Over time, you begin noticing something interesting. The traders who survive for years are not always the most brilliant. They are often the most consistent. And consistency rarely comes from talent alone. It comes from habits. Think about it for a moment. What does a trader actually do day after day? They observe. They prepare. They monitor conditions. They review results. They repeat the same process over and over again. Trading is not a single performance. It is a continuous routine. That distinction matters. A talented person can produce an impressive result on a particular day. A strong routine can produce results repeatedly. The market rewards repetition far more than occasional brilliance. Why? Because outcomes are created through accumulation. One day does not define a trading career. 1 week does not define it either. What matters is the behavior repeated hundreds and thousands of times. And repeated behavior is governed by habits. This is why professional traders often appear less exciting than people imagine. Many newcomers expect trading success to look dramatic. They picture constant action, rapid decisions, and endless market activity. The reality is often much quieter. Professionals spend a surprising amount of time doing ordinary things consistently. They prepare before opportunities appear. They maintain records. They follow routines. They organize information. They create structure around an environment that is naturally chaotic. That structure becomes valuable because markets are unpredictable. When the external environment is uncertain, internal consistency becomes even more important. The routine serves as an anchor. Without it, every day becomes a fresh improvisation, and improvisation creates problems. If preparation changes every morning, observations become inconsistent. If observations become inconsistent, decisions become inconsistent. If decisions become inconsistent, results become difficult to evaluate. Soon the trader no longer knows whether outcomes are being driven by market conditions or by constantly changing behavior. The absence of routine creates noise, and noise makes improvement difficult. Have you ever noticed how easy it is to underestimate simple habits? They rarely feel important in the moment. Reviewing notes feels ordinary. Preparing watch lists feels ordinary. Tracking observations feels ordinary. None of these actions create immediate excitement. Yet over months and years, they begin compounding. Small observations accumulate into experience. Experience improves judgment. Improved judgment leads to better responses when opportunities appear. The benefits arrive gradually, which is exactly why so many traders overlook them. People are naturally attracted to dramatic solutions. Habits are not dramatic, they are repetitive. But repetition is precisely what gives them power. A single day of preparation accomplishes very little. A year of preparation changes the way you see the market. A single review session reveals little. Hundreds of reviews reveal patterns that would otherwise remain invisible. This is where professionalism begins. Not with intelligence, not with predictions, not with extraordinary talent. It begins when a trader stops relying on motivation and starts relying on routine. Motivation comes and goes. Markets change. Conditions fluctuate. Energy levels rise and fall. A habit continues regardless. And that reliability creates a significant advantage because trading is not ultimately a test of what you can do occasionally. It is a test of what you can do consistently. So pay attention to your routines. Pay attention to the actions that occur whether the market is exciting or quiet. Pay attention to the behaviors repeated when nobody is watching and no trade is active. Entering a trade is often treated as the difficult part. In reality, entering is usually the easiest part. By the time you enter, you have identified an opportunity, made a decision, and committed capital. The hard work appears to be finished, but in many cases, the real challenge has only just begun, because once a position is open, something changes. Before entry, you are analyzing the market. After entry, you are managing a position. Those are not the same task. The moment a trade becomes active, time enters the equation. Price begins moving. Information continues to arrive. The market starts revealing details that were unavailable when the trade was initiated. Now a new question appears. What should be done with the position from this point forward? That question is what makes trade management so difficult. Most people imagine a trade as a straight path from entry to exit. The market rarely behaves that way. A position may move in your favor immediately. It may stall. It may advance, pull back, and advance again. It may appear successful before becoming unsuccessful. It may appear unsuccessful before eventually working. Between entry and exit lies a constantly changing situation, and that situation requires ongoing judgment. Have you ever noticed how different a trade feels after it begins moving? A position that looked attractive before entry can suddenly feel uncomfortable after a small pullback. A modest gain can start looking significant once it belongs to you. The market itself may not have changed very much, but your relationship to the position has changed. You are no longer observing from the outside. You are involved, and involvement creates complexity. This is one reason trade management becomes such a critical skill. The quality of a trade is not determined solely by where it begins. It is also shaped by what happens afterward. A trader may identify the correct opportunity, but handle the position poorly. Another trader may identify the same opportunity and manage it effectively. The entry is identical. The outcome is different. Why? Because trade management influences how much value is ultimately extracted from a correct idea. This is where many traders discover that forecasting direction is only part of the challenge. The market may move exactly as expected, yet questions still remain. Should the position be held? Should exposure be reduced? Should profits be protected? Should room be given for further movement? These decisions emerge after entry, not before, and each decision influences the final result. The difficulty increases because the future remains uncertain throughout the life of the trade. A favorable move today does not guarantee a favorable move tomorrow. A temporary setback does not guarantee failure. As conditions evolve, decisions must evolve alongside them. The position becomes a living situation rather than a fixed prediction. That reality surprises many traders. They spend enormous effort refining entries while giving far less attention to what happens afterward. Yet a trade can spend hours, days, or even weeks under management. The entry itself may take only a few seconds. Think about the imbalance. A few seconds are spent initiating the position. Much longer is spent managing it. Naturally, the longer phase deserves careful attention. The market understands no distinction between a good entry and a poorly managed position. It only reflects the final outcome. That is why experienced traders often become students of behavior after entry. They observe how positions develop. They study how trends progress. They learn how market movement unfolds over time. Because the initial decision opens the door, but management determines how the opportunity is ultimately experienced. So when evaluating a trade, look beyond the entry point. Look at the period that follows. Observe how conditions change after commitment has been made. Observe how opportunities evolve while they remain open. Because the market does not end its conversation with you the moment you enter a trade. One of the reasons trading remains difficult year after year is that the mistakes are rarely new. The market changes. Prices change. Technologies change. Yet the same costly behaviors continue appearing generation after generation. You would think traders would eventually learn from the mistakes of those who came before them. But trading has a unique way of teaching lessons only through experience. People read about mistakes. Then they repeat them anyway. Why does that happen? Because mistakes in trading rarely look like mistakes when they are being made. They usually look reasonable in the moment. That is what makes them dangerous. A trader chases a move because it appears to be the beginning of a major opportunity. A trader takes a weak setup because it appears close enough. A trader enters another position because one more trade feels like a productive use of time. Each decision carries a convincing story, and that story hides the mistake.